Perfect. So today's topic of discussion is going to be on hedging. And when we discuss hedging, there are different contexts to the discussion on hedging, right? Because if you look at, for example, this little notepad I made right here. If you're a portfolio manager versus an individual investor, there's very different contexts for how you're going to hedge, right? You need to be very mechanical about how you do it and methodical as a portfolio manager because your primary concern is limiting drawdowns. Um, as an individual investor, obviously you want to limit drawdowns as well, but the tools available to you are not as broad as if you're a PM. Now, there are kind of three ways you can look at hedging. The first way is to correlate your portfolio to a broad index. That require you to pretty much determine each position you have, the beta weighting against like S&P, for example, and then tabulate your overall portfolio beta. And that would delineate how you'd hedge against, S&P, for example, right? It's costly, obviously. That's a drawback. And the correlation might be off somewhat. But for example, let's say that you're heavily correlated to S&P 500 and you want to use the S&P as a hedge. And so you might say, okay, I'm going to look at the S&P over the past year and I want to limit drawdowns of 5% or more, perhaps. Or perhaps you're fine with a drawdown of up to 5%, right? Because again, there's no free lunch in the market. You need to understand that taking risk is part of seeking reward, right? You can't have reward without risk unless you find arbitrage, which is rare. But let's say you're looking at, for example, SPX. You say, you know what? I don't want to experience a drawdown like we had in April where we fell 21% in a matter of, a month or so, right? So maybe you're comfortable with a drawdown of, let's say, we've seen numerous declines of like 3% over the past year, roughly, from a high to a low. So you might say, I'm fine with a drawdown of like 5%, for example. That might be your basis. So what you would look for there is how would I benefit my portfolio where if the market were to sell off and I'm correlated perhaps, let's say 1-to-1 with S&P. Obviously, if you're correlated to less, like let's say you're positioned more defensively, in that case, you probably don't need as much of a hedge because, a decline in the S&P of 5% might result in a decline in your portfolio of 2.5%, right? Now, if you're overly weighted on high beta names like Tesla or Nvidia, for example, um, that's where you're going to have issues because obviously you're going to see massive volatility in your portfolio, right? Let's say your portfolio beta is like 2 or 3. In that case, if the S&P is down 5%, you're down 10 or 15%, right? Now you can obviously dampen hedges there by yourself by looking at each individual position, and I'll discuss that in a second. But back to the point of discussion here, using broad indexes to hedge your portfolio. So let's say that you want to look at SPX going out, quarterly, and you say, you know what, I'm fine with a drawdown of 5%. So a drawdown of 5% from the current level would take us to roughly 6,500 area, right? So looking at that, the option chain here, right? 1 second, I'm pulling it up for you guys. Just in the chat. Perfect. And again, if you guys have any questions at all about what I'm saying, just post them in chat. I'll address them after. I have about half an hour roughly to talk. And then I need to hop off, but let me see. Okay, so here's the option chain, right? So if we're going out to, let's say we go out to March OPEX instead of January. January might be too soon. And again, hedging every month, it's time consuming, it's costly. You want to have hedges that are in place for an actual drawdown because let's say, for example, we rally into January OPEX and then we sell off thereafter, and you had a hedge in place for January, you might watch your hedge expire and then you need to purchase a new one for February, for example, right? That's very time consuming and costly as well. So looking out to, let's say, March OPEX quarterly, capturing the next earnings season as well. We mentioned that a 5% decline in broad markets would result in a move down to about 6,500 or so. So looking out there and saying, you know what, if I were to purchase a put option on its own at 6,500, I'd be paying about $100 on SPX. Now, do you want to spend 10K on a single contract hedging your portfolio? Let's say your portfolio is 100K. It doesn't make much sense, right? However, if you use spreads, spreads are your friend because they reduce the cost of hedging, right? So you can, for example, do like a 100 wide spread here and say, I'm going to buy this put spread on SPX. And if we decline to 6,400, for example, I'm spending about $16 to make $84. So that would require a decline on the broad market index of SPX. Let me just pull that up 1 second. Bear with me here, guys. So if we were to pull down from the current level, that would be a decline to 6,400 of about 6% or so, right? So basically what you're saying is, you know what? I don't mind a drawdown of 5%, but beyond that, I want to be hedged. Now, if we pull back about 6% and we settle here into March OPEX, this position can be monetized for probably about 2 to 3x overall. So you'd be spending about $16 to make $84, right? You know, when you do the math on that, you know, 84 over 16, you're making 5.25 your overall outlay. Now, if your portfolio is, you know, for example, 100K, and you have an outlay of $1,600, you're risking 1.6% to hedge yourself beyond a decline of 5% in broad markets. And if we were to decline by, for example, 6% plus, that would pay you $84, which would give you a return of 5.25% on your overall risk, which would offset your overall decline because your portfolio would decline by, let's say, for example, 6%, but your hedge would then pay 5.25%. Your overall decline would then be about, you know, 1% roughly, right? So this is one way of building hedges out in your portfolio. Now, to like elaborate on this idea, what one could do as well is, let's say you're correlated 1-to-1 with the S&P. You could say, okay, well, I'm going to go ahead and I'm going to sell call spreads out of the money on SPX because if we run higher, my portfolio is going to go up in value. And I'm okay with, you know, perhaps capping the upside in the short term at the expense of paying for my insurance and not having too much of an outlay. Because one thing you don't want is your insurance costs, your hedging costs, to create a drag effect on your portfolio returns. Because if you're spending, for example, like 1 or 2% every quarter on hedging your portfolio over the course of the year, you're dragging your returns by about, you know, 4 to 8%, right? No one wants that. And in the long run, the market goes up and to the right. So most of the time, hedges are kind of, you know, not useless, but not really necessary overall. Now, this is where you want to pick your entry point. So, you know, we're at all-time highs, and you see, for example, economic variables that are turning sour. In this case, right now, we're seeing, you know, job creation is not as high as it has been historically. Rates are being cut even while we're at all-time highs, even while inflation is still somewhat high as well, above the average inflation targeting metric that the Fed uses or is supposed to be using anyway. So you want to kind of like plan ahead of time and say, you know what, I know that the economy might be turning sour. And again, the market is not the economy, right? So you got to remember that too. Like for example, you know, will Nvidia suffer heavily if the economy enters a recession? I mean, probably not, because the spending on AI data centers likely will not slow in the event of recession. Now, will, you know, shopping malls and perhaps, you know, restaurants suffer? Yes, right? Tourism might suffer as well. But that's not the point of the discussion here right now. So back to my point on selling out of the money covered calls on your portfolio. Let's say you said, you know what, I'm cool with capping my upside to 7,200 on SPX by March OPEX, right? So you go ahead and you sell that call option. But again, you don't want to be naked because you don't want to watch it run higher and remove some of your gains. You need to cap your downside over here, right? So you're getting what, $52 credit over here. If you were to sell, for example, the 7,200 and buy the 7,250, what happens here now, right? You pull in a credit of 12, you reduce the cost of your overall hedge from 16 down to only 4, right? Now you've kind of bracketed your overall position in the market. Like we have upside on SPX of 7,200, and we're dampening our downside below 6,500, right? So a very effective way to hedge, because if we go up, then your portfolio will increase in value, offsetting the cost of this hedge, the small cost. In this case, now you're risking really about $4 or so to make $96 on the downside hedge. Let's say we were to crash down to 6,400, for example, and this were to pay out max value, which you're probably not going to get maximum value if you were to monetize it early. This would be at expiration, essentially. Or if we crashed all the way through both strikes down to like 6,000, for example, then you can monetize it. But the point here is that, again, if you were to outlay, for example, 1% of your portfolio risk at $4 to make 96, I mean, you can do the math on that. You're making about 20% plus return on your hedge, which would then offset any downside movement in your portfolio, right? Now, that's one way of looking at hedges. The next way is to look at each position individually. So, for example, like I mentored someone who had a portfolio or has a portfolio, and he's primarily in Tesla and Nvidia. And he's always telling me it's so volatile, like he's up or down a lot on a given day. And I said, well, you want to be exposed to high beta names, you need to be willing to endure that volatility in your portfolio, right? But that being said, how could you hedge, for example? Let's say that you're long a name like Tesla or Nvidia, for example, right? Well, a cheap way to do it is using callers, right? Selling a covered call to finance a put option as insurance on your position. So you're saying, you know what? I'm okay with hedging my or capping my upside in the short term at the expense of essentially hedging myself on downside risk, right? So let's say we're looking at Tesla for argument's sake, okay? Not that I'm condoning buying Tesla. I think it's very overvalued right now, but that's not the point of this conversation. But let's say you're saying, you know what? I think Tesla will stay at, below 500. So I'm fine with capping my risk at 500. Now, like logically speaking, I would just say, okay, well, if you're fine with, doing a covered call at 500, why not just sell your shares and move to cash, right? Another form of hedging is being in cash, because obviously cash will lose value to inflation only, really, right? But the point here is, if you were to own Tesla and you want to hedge out your risk on Tesla, let me pull up the option chain here. So let's say you sold a covered call on Tesla for, again, maybe we focus on March just for continuity sake. So the covered call there is about $50 overall. You sell one covered call per 100 shares you have. Now, the problem here is, as an individual investor, if you have less than 100 shares, this strategy is not available to you because you can't sell that covered call against, for example, like 30 or 40 or 50 shares, right? It has to be against 100 shares, because the call option will give you the right, or sorry, you're selling the right to someone else to sell your 100 shares at the strike price by expiration, right? So let's say, for example, you sell this covered call at 500, you pull in $5,000 per position, and you use that premium. You can buy, for example, the 450 for $30. You can buy the 400 for $15 if you wanted to. Basically, you're saying, you know what, I'm fine with selling Tesla at 500 plus the $50 in premium, but I don't want to watch my portfolio decline by more than like $80, for example, right? In that case, you would just say, okay, I'm going to buy the 420 put option. By doing a combination here of selling the $500 call option and buying the 420 put option here, you have a credit of $30, meaning that essentially your upside is to 500, but you have a credit of 30 additional. So you're actually at 530, and your downside would be to 420. So you'd have 70 downside in the short term to March, an upside of 40 roughly, right? And again, you might be fine with that. Maybe you say, you know what, I'm going on vacation for the next few months. I don't want to worry about my portfolio at all. And I'm okay with capping my upside at the expense of hedging my downside. Now, again, this is kind of cumbersome for a larger portfolio where you have 20 different names, for example. To do this for every single name is very cumbersome, which is why I mentioned the first approach, looking at your overall exposure to the S&P, for example, or the NASDAQ, and then hedging by using a broad market index hedge instead. Now, the third discussion point we have here is on pair trading your positions, right? So again, this is where like a hedge fund, for example, if you've heard of a long short hedge fund, most hedge funds are long short. What does that mean? That means that They're going long names that they believe are undervalued, for example, or have upside, and they are shorting names that they believe are overvalued and have downside. And the idea is that if the market were to crash, for example, you're going to monetize your shorts. If we push higher, your winners will offset the losses on the upside moves, for example, right? Now, this requires larger portfolios. It's expensive borrowing cost wise because you need to be shorting shares, for example. But
Too
you can also
close.
build positions out with your portfolio using options
Maybe
too. Not the most effective because, like for example,
like
a typical pair trade would be, Pepsi, Coca-Cola, right? Two names that are correlated
I see you
pretty,
too.
pretty heavily,
Audio.
but not perfectly, right? The reason why you don't want a perfect correlation between two names is because um, they would move then in tandem almost all the time, right? You want to have roughly a zero point 0.6 to a zero point 0.7 correlation, essentially, right? If you know statistics, this is where requiring a stats knowledge is important, and not everyone has that. But again, you can just Google it or ask ChatGPT, how do I determine a coefficient of correlation between two different variables? And then what you do is you match up essentially all the closing prices of each name side by side in the spreadsheet, and you can determine the coefficient of correlation of those numbers. The idea there is that zero delineates that there's no correlation whatsoever. -1 determines that there's a perfectly inverse correlation, that being if asset A goes up by 1 point, asset B goes down by 1 point, right? And then the other one is if they have a coefficient of correlation of 1, that means they move in tandem 1 to 1, right? If asset A is up $1, asset B is up $1 as well, right? So again, not ideal for individual traders, but for portfolio managers, it's a great way of hedging out your portfolios. You might say, for example, like I mentioned on the podcast, the long and short of it on Patrick Sarrazin's YouTube channel a couple months ago. I mentioned go long AMD and go short on Nvidia, right? At the time, Nvidia was $180 per share. AMD was like 156, 160-ish. Now, AMD is 205 and Nvidia is 175. So what would have happened there is you would have made $5 on the short on Nvidia. You would have made about $40 on the long on AMD. So that's kind of a way to think about how to position yourself using pair trading in your portfolio or a long short portfolio overall, right? But again, as an individual, having the capital required for margin to sell short a given name is not really feasible for most people, right? So for portfolio managers, yes, but for individuals, not so feasible. So overall, again, like the whole idea is that you want to limit your drawdowns by hedging, because if you were to work backwards, like how do I get to my objective of, for example, beating the S&P 500 overall longer term? And in order to do that, you need to limit your drawdowns essentially, right? So limiting your drawdowns entails taking asymmetric risk to the upside so that if you're correct, you make money on the upside. If you're incorrect, your loss is kind of overall not too meaningful overall, right? Again, hedges can be expensive. So depending on the way you decide to hedge, you need to determine if it makes sense for your portfolio and for your objectives overall. Because again, like if we have a pullback like we had in April where it pulls back down, but you're in a retirement portfolio you don't really care about, in the short term, you're better off probably just leaving it and letting it play out over the next 5, 6 years because long term, we should see it go up and to the right. That's my TED talk, so to speak. Any questions, guys? Let's see. Anyone questions? No? I think you had a question in chat the other day, right? About hedging? Oh yeah. So cash on the side. Um, For me personally, I'm always roughly 50% cash or more because I'm only conveying my long theses via options. So because of that, you don't need to have as much cash allocated because you are, essentially long positioned with asymmetric risk. Like, for example, let's say that you wanted to own, I don't know, it doesn't really matter, but let's go back to option chat again, right? Let's say you wanted to own, for example, I don't know, AMD, right? As an example. And you can buy 100 shares right now for about $20,000 US. Or I could go out a year. Let's see, I go out to January 2027. Where is it? Whoops, my screen's cut off. That's why. Let me change my screen a sec. Minimize that. Okay, there we go. 27. So let's say I went out a whole year, right? I could, for example, say, you know what? I'm going to go ahead and I'm going to buy the 120 strike 90 delta call option on AMD. You might be wondering, like Nick, why would you do that, right? You're paying like 9,000 and change instead of paying $20,000, right? Now, let's say AMD fast forward 1 year is at 250, for example, right? This call option is worth 250 current price minus the strike price of 120 or 130, right? So I would have then made 130 less my cost of 95, $35 of profit on the position, right? Versus if I bought the stock, I would have made roughly $47 of profit, so more dollar profit overall, but a much, much lower percentage return. And also at a higher risk, because look at the current spot price, strike price, which is the $200 strike price. It's about $50 right now for the $200 strike price call option, which means that if tomorrow AMD fell down to 120, right, this position would be down at about $50 per contract overall, which means that I'll be down about $4,500 roughly on my position. Whereas on the stock itself, I'll be down about $83 overall. So it acts as a hedging mechanic because essentially I can convey upside at the expense of paying a little bit of premium while also keeping my downside very, very dampened overall. So in this case, back to your question overall, Nino, let's say you want to be long on AMD, we want to keep on cash, right? Well, you could buy 100 shares for 20 grand, or you could buy one call option for 9.5 grand. You have the same upside pretty much. You're just exposed, pretty much less than 50% overall is sitting in cash, right? So that can kind of act as your little hedge if you wanted to. And then if you're in a margin account, you can sell poor man covered calls by essentially saying, you know what, I'm going to buy, for example, this strike price, and then I'm going to sell, like, let's say I sold, for example, the March 250 strike price over here for $7, and I would chip away at my cost basis incrementally over time to lower my overall cost basis. If we push above 250 by March, for example, then I could either buy this back for a loss and sell my long position and then roll up to a higher strike, or take assignment of this contract where I'm short 100 shares and then opportunistically pretty much close it out against my my long call option, right? So basically, if it fell back down below 250, I would just buy back the 100 shares that I'm short now. And remember that I had a long call option, so I'm hedged the entire time. Hopefully that helps, Let's see in chat here. Yeah, so Sherm asked the GHEQX approach is very solid. Yeah, I mean, it's the most basic way to hedge a massive portfolio because, again, you might say to your clients, listen, guys, we're happy with providing you with returns in excess of the S&P. If the S&P runs, for example, 8% this quarter, we will cap our upside, but also if it crashes 20%, we're hedged, right? And again, most investors, like the more money you have, the less you care about massive returns and the more you care about wealth preservation, right? So you want to focus, like when you're starting out, as Charlie Munger said, the first 100K is the hardest to make, right? Beyond that, you can keep on growing your portfolio in a pretty rapid manner, right? But as you get larger and larger in size, you care less and less about massive returns and more about, cash flow generation, wealth preservation, right? So again, like you need to determine your overall objective, right? Nino asked, how much percentage would you spend on a hedge? Typically no more than like 1% or so, because again, you don't want to drag on your portfolio. Like if you're hedging, for example, and it's costing you more than that, basically in a flat market, you're just losing money on your hedges recurringly. It's almost like an insurance cost, right? Like maybe you have a vehicle, you're paying for your car insurance, but you're not using it at all, right? Yes, it sucks to drag on your overall cash flow and your overall returns in your portfolio, but having a hedge makes sense in certain cases where, let's say we're at all-time highs. Like for example, you wouldn't be buying hedges in like April or during COVID, the COVID crash. Like buying a hedge then makes zero sense. It's too expensive, right? So there are times when you want to hedge and times when you don't care so much about hedging. And like, for example, if you have a binary event like an FOMC or an election, a key earnings event like Nvidia had recently, you can go with a collar hedge and just say, you know what, I'm gonna hedge very short term because I don't want to have that extreme volatility in my portfolio. Yes, I'm capping my upside, but I'm also hedging my downside as well. Um, yeah. So that's kind of the problem is in certain retirement accounts, they're not margin accounts, so you can't trade options in the same way you can in a margin account, right? You can, however, you should be able to buy put options in your retirement account, though. You should be able to. Jonathan's asking what platform is this? This is IBKR, Interactive Brokers Option Chain. Amazing platform. I have no affiliation to them at all. I use them. Solvire asks, do you use Greeks to hedge your overall exposure? So yes and no. Like the short answer is not really. I look at historically what's happened over the past couple of years. What has been the average drawdown in the broad market? Like for example, if you're looking at the S&P and we're saying, okay, what's the S&P done in the last few years, right? So if you look at a couple years out instead, weekly, the biggest drawdown we've had was during April because of the tariffs, right? But aside from that, we've had these minor pullbacks of like 3.6%, 2%, 3.5%. Even recently, pullback here has been very, very nominal overall, right? So hedging beyond 5% makes sense. The reason why it's much, much cheaper. And you need to understand, again, if you're taking risk to seek reward, you need to be okay with some risk. You can't say I'm gonna have no risk at all. If you have no risk, most of the time you have no return at all, essentially, right? Over here we had a pullback of what, like 10%. So in this case, for example, let's say you built a hedge in at all-time highs and said, I'm okay with 5% decline, but beyond that, I want to have hedge. So you might have built a hedge, for example, like over here, hedge yourself down below a 5% decline, that would have paid off. Now, the key thing is to remember, and again, Dan mentions this a lot, when you get a pullback down, most hedges are monetized, which has like a reflexive reaction to the upside because now puts are closed out, right? So it causes like almost a rubber band effect to the upside a little bit. Most participants don't hang on to their hedges when the VIX is above 30, for example, right? Like that doesn't make sense. But again, like going back even a couple of years, saying okay, 5% over here, we haven't had many drawdowns beyond 5%. We had one over here, and then we had what was this over here? Again, like 5%, right? So basically, what I'm saying to myself is I'm fine with a 5% decline in the broad market. Beyond that, I want to be hedged. So I will purchase out of the money put spreads, financed by out of the money call spreads, perhaps. Very, very pure asymmetry of risk there. Not a large portfolio drag overall on your insurance costs. It's just a great way to hedge overall, right? In the case of April or like COVID, for example, those are harder to time because it's kind of like a black swan event essentially, right? Like COVID, I remember in February 2020, we're at all-time highs, and puts were very, very, very cheap. You could have bought insurance for almost nothing because everyone's thinking more upside, right? So yeah, like buying these hedges when looking at like a beyond 5% decline makes more sense versus looking at like Delta, for example, because Delta, I mean, you can use it sure if you want to, but you want to look at historically what's happened in the broad market and say, okay, well, most of the time you fall by about 5% and then bounce. In the last couple of years, we've fallen by more than 5% only two times pretty much, right? Once during April and once back in what is this? I can't see my screen. July of 2024, right? So last summer pretty much. That's basically it. Yeah. Hopefully I answered your questions, Silvira. Any more questions, guys? All right, awesome. I don't have much more time right now, so hopefully this helped with you guys. If you have any questions, up or down from here. Um, I'm bullish into January OpEx, but beyond that, I'm quite bearish. I Again, you need to understand that the stock market is not the economy. But that being said, we're seeing a lot of economic data that supports the thesis that we'll see a recession in the next year or so. And this might be a very bad recession because of how levered most corporations and individuals are as well. It might be worse than 2008, 2009. Um, and again, like I, I always want to control the controllables in my life, right? What can I control personally is how much money I'm making in my own portfolio, as well as how much money I'm not losing by building out hedges that make sense to me, right? But remember, like you don't want to be ultra bearish. Like people that lived through the '08 crash, they have this kind of like PTSD where they think no matter what, we're going to see this huge decline in the broad market, kind of like Michael Burry in a way, right? But the problem is that the markets are designed to go up. Like for example, the S&P removes poor performing companies, every quarter and adds in stronger performers for a reason, so that we keep going up and to the right, right? You're not going to see like these crappy companies stay in the S&P that aren't performing very well. So it's designed inherently as a wealth preservation slash retirement vehicle, which is why pension funds buy the S&P 500, for example, right? Now, I mean, there are questions as to like, if I'm holding US dollars and I'm a European, for example, like how do I hedge that? That's a more nuanced discussion, which I won't get into right now. But um, overall, like short term, I think up and then down or choppy or flat perhaps. So like building out hedges into March to me makes sense. I'm happy with upside to like 7,200 on SPX and hedging my downside to like 65 or below. Um, as you see rotation as well. Yeah, so rotation would make sense in a defensive environment, right? That's kind of why I like Netflix a lot, because I view Netflix as like not a tech company, as more of like a consumer staple, but also a tech company, right? Like they'll benefit in both environments. In a downside market move overall, you got to think like even in a recession, will people cancel Netflix? Probably not, right? So names like Netflix or Costco, for example, are good staples to hold, like a Walmart perhaps. But there is exposure to obviously tariffs and that kind of information as well, right? So yeah, yeah, euro dollars.
Ja,
We're
man.
talking for
Ja,
about half an hour, guys, so
det
I'm
är
getting
tur.
a bit tired of talking. But if you have any questions about what
Jag
was
är Dennis.
discussed, hit me up. I'm happy to talk and share my perspective. Hopefully this helped. And you guys, stay safe. Have a great day.
Come mai?